Hi guys, good afternoon and welcome to Money Control. I'm Karunya. With me is Manisha Gupta and all eyes today on metal prices. Manisha, whether it's zinc, copper, aluminum, all of them are surging away. Tell us what's the trigger.
Oh, well, yes. Even as the Chinese data did not come so well, whether it was retail sales or factory, but the point being that China surprised you with an interest rate cut is what really supported the market. And then China has talked about its commitment to giving out stimulus, injecting more liquidity, and giving out more liquidity for infrastructure, what really is supporting the metal prices. Also, we've been talking about on how we are looking at inventories declining. Europe really seems to be a bigger concern right now, where we have seen more smelters now add on to the list, a long list rather, which are closing down production or smelting because it is just not viable to keep producing metals with the kind the energy prices are moving. Karunya, let me tell you this. Earlier, when you look at zinc and aluminum, 40 to 50% used to be the cost of production where energy was a part of it. But now energy constitutes 80% of cost of production. That is the kind of run up that we've seen into the prices there, and it is absolutely turning unprofitable for the producers and smelters in Europe, and is the reason you are looking at more and more names being added.
But we talked about this last week as well when metal prices were witnessing an uptrend and the view at the time was cautious. Is the street view changing now? Is it turning more optimistic? What are traders saying?
Oh, absolutely. And Karunya, I do want to say I told you so because last time we spoke about metals, we talked about on how now we will not see a decline. A bottom perhaps has been made. This is the time you could see a turnaround come in for metals. And that's exactly what we are seeing into the markets here. We are nearly 50 to 15 to 20% off the kind of lows that we have made. Yes, we are far away from the kind of highs we've made in this year as well. But it does look like a time when you can continue to be long in case of metals. Take a look at zinc, and the inventories are less than 50% of where they were in the last year. With the kind of smelter closures that we saw in the last year, there is more addition on that coming in for this year as well. So the supplies are cutting down, production is going down, inventories are going down as well. And if China does come out with that stimulus, we will see support and demand come back. China is going to be a major player into the markets right now. There is an expectation that a lot of pent up demand is still waiting to come in, and that could come in by the end of this year. So, your top picks here are perhaps going to be zinc, aluminum, and copper in this space.
You haven't touched upon steel prices or iron ore. What's happening in that space?
Iron ore isn't very positive right now. That is because there is enough and more inventories. There is more steel already produced. Inventories with the Chinese mills also is on the higher side. So I wouldn't really bet so much on iron ore. This year does seem good, but with the kind of supplies that are coming in, with the kind of storages that China has, you could be looking at lower lows continuing in case of iron ore. Steel, yes, does look positive. There is enough inventory there already, though. But I would still want to look at something like a zinc, which is gained up by nearly 15% in last 1 month, or an aluminum, which is gained up by 18% in last 1 month. These are the two metals which have very strong energy as a cost of production. So everything that has to do with gas, which by the way now is trading above $9, $9.5 per MMBTU, that is where the major concerns are. Anything to do with an input where you have gas as a usage, electricity as a usage, should be looked at in the brackets which says inflation.
Right. But does this mean there could be some pressure on users, on cap goods companies, auto companies? Many of those who use these metals, aluminum, zinc, heavily as part of their raw materials.
Oh, well, absolutely, yes. The problem with these companies really has been that when the prices were high, the demand in any case wasn't there. But now with the demand picking up and the lull being done, if they stocked at those levels, great. If they did, then they would be buying at higher prices from now. And higher prices also in the sense that there is the concern about availability as well. When you look at the LME warehouses, there's a very sharp decline that we've seen for many of these metals, and much of the stock that is lying in the LME warehouses also is already marked for delivery. So it's not that you go and buy today and you want to make a contract and the metal is easily available. If you want it in immediate basis, you have to pay a premium for that as well. So yes, buying on ground as of now is getting tough. And with the markets already factoring in that Europe is going to produce less and less, we've seen Dutch Naira that information coming yesterday for zinc. A couple of more companies today in Europe have put out guidance saying that they will not be producing at least until September and or until October, does tell you that the productivity, at least in Europe, is going to go down.
Okay, well, all eyes now on China's stimulus as and when it's announced. There could be a further push, a further boost to metal prices. But for now, clearly, they seem to be going strong. And that is all
Yes.
the update we have for you. Thank you so much, guys, for tuning in. And thanks, Manisha, for joining in with the update.